Monetary tightening across the globe on the back of elevated inflation and the Adani saga has kept the Indian markets jittery since the beginning of 2023. On the back of this, India's valuation premium has slightly come down. India's market cap to GDP ratio, also known as the Buffett indicator, has now dropped well below the 100% mark. Now, before we dive into the data, let's cover the basics. What is the Buffett indicator and how is its value calculated? The Warren Buffett indicator is calculated by dividing the total market cap of all publicly traded stocks in a given country by that country's GDP. In other words, this indicator compares the size of the stock market to that of the economy. This indicator also suggests that the market cap of listed companies in a country should not exceed the country's own GDP, that is cross 100. If it does, the market is deemed expensive. Considering India's nominal fiscal year 23 GDP at rupees 272 trillion, India's total market cap to GDP is now trading at 97.2%. In fiscal year 21, the Buffett indicator stood at 103%, while in fiscal year 22, the figure stood at 112%. Now, while this indicator is below 100%, it is much above the long-term average of about 79%. Warren Buffett is a well-known name in the investor community, and this indicator is named after him as he famously describes the ratio as the best single measure of where valuations stand at any given moment. Do know that the indicator cannot be used in isolation and has its own limitations. But over the last few months, India's valuation premium versus emerging market peers has narrowed considering the forward P ratio. While it still commands a higher valuation than its peers, this premium seems to be justified due to India's better growth prospects. In the near term, we will of course face headwinds from inflation, monetary tightening, and external headwinds. We at Research and Ranking and Informed Investor believe in the fundamentals of long-term investing. Now, the underlying fundamentals and growth prospects of India are strong. In these volatile times, it is best to focus on quality companies whose fundamentals are appropriate to current macroeconomic conditions, to be diversified, to adjust your risk level and also invest for the long term. Now, with this, you will just sail through the uncertainties. As we saw, the Indian benchmarks have remained volatile, but sugar stocks are on the rise. Most of the sugar stocks have spiked a good 6 to 20% to the upside. So why are the sugar stocks rising? International sugar prices have hit a 6-year high. Now, this is on the back of low production in a few countries. While Brazil is still yet to harvest the crops, European production has been hit by drought. India, on the other hand, is diverting most sugarcane to make ethanol. Now, sugar stocks have rallied in the hopes of rising domestic prices following the global trend. Another reason is the government has also indicated that it will allow an additional export of 1 million tons of sugar. However, this will only be possible if the domestic output meets the government expectation of 33.6 million tons of sugar production. Now, the other reason is the strong demand for ethanol blending. For fiscal year 23, about 5 million tons of sugar is estimated to be diverted for ethanol production, making sugar high in demand. So what does this news mean for you? India is expected to retain its tag as one of the fastest growing economies in the world. The underlying fundamentals and growth prospects of India are strong, and the short-term headwinds will have a minor impact on the country's long-term outlook. This will have a direct neutral impact on you. The sugar stocks are rising in the short term with the hopes of domestic prices rising as global sugar prices are at a 6-year high. The sugar sector in India has become self-sufficient, thereby meeting its own consumption and ethanol demand while also exporting to other countries. This will have an indirect positive impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.